I want to show you in this series how to record transactions in a general ledger. To do that, I'm going to start you off by taking you through a worksheet which will help you to process the steps that you've got to follow in identifying how to get the transactions into the general ledger. So I'm going to start with this very simple spreadsheet. It's actually an accounting equation worksheet, which is just another way of presenting a general ledger. The reality is we don't present it like this because it's too bulky and cumbersome, but it's great to learn, and sometimes for your own personal purposes you can easily keep track of your own personal accounting with a spreadsheet like this. So the first thing is we have the elements. You can see them down below here: asset, liability, income, expense, and equity. So those are the elements. Now, out of those elements, you'll find some or all of them in every transaction. So an asset is something that you own. A liability is something you owe. You can have a look at the detailed description beneath if you want to. Income is an inflow of benefits, not an inflow of money, an inflow of benefits. Expense is an outflow of benefits. And equity is assets minus liabilities. So the first step, let's have a look at this first transaction. The owner deposits money into a bank account. First step is to say, well, which elements are involved? Well, it's money, assets, and it's the owner's money. You can think about it like this: if equity is assets minus liabilities, after this transaction, the owner's put money in, there's no liabilities. I would expect the owner's equity, if it increased, by 1,000 Rand. So the other element is equity. It's the owner's interest in the business. That's what equity is. So the next thing I do is I subcategorize it, and I say, what type of asset does this money, where am I going to show it in my ledger? Well, if I banked it, I'm going to show it in bank. And the owner's capital contribution is put into a capital account. So now I've got a bank account and I've got a capital account. Next step is to go and have a look quickly at this rule over here. When you look at this rule, you can see on the left hand side you've got the word debit, on the right hand side you've got the word credit. Now, I'm not into mnemonics and things here. This is easy to remember. You just have to commit it to your mind. And the more you work with it, it just becomes second nature anyway. So the debit side is the left side, the credit side is the right side. I'll put here plus, because sometimes in electronic accounting packages, your debits are shown as a positive and your credits are shown as a negative. Now, we're looking for asset and we're looking for equity. Now, if an asset account has a debit balance, normally, how would you decrease it? Well, the answer is you would decrease it with a credit. And an equity balance normally has a credit balance. How would you decrease it? With a debit. So now, just following on from there, let's just take this rule: asset increasing, I must debit; equity increasing, I must credit. Now, I'm simply going to go, there is my capital, it increased by 1,000. There's my bank, it increased by 1,000. And here are my rules at the end. Which account do I debit and which account do I credit? Now, we know the bank is an asset, therefore we debit bank with 1,000. We know that capital is a equity balance, Therefore, it's increasing, I must credit it.